this session, which is all talking about passive income, is all really good news, or it should be good news, because I'm talking here about what opportunities exist for doing some planning to take advantage, to make the best of how passive income, how non-earned income, not trading income, not income from employment, not income from actually getting out and doing something, as it were, income instead from the receipt like a royalty or a dividend or an interest payment, because of the way that passive income is taxed and because of the way that withholding taxes work on that, there are some big opportunities for tax planning and for structuring things in a highly tax efficient way. So that's what I'm going to be talking about this afternoon in this session, which is all good news, isn't it? Everyone happy about that? Okay, I'm happy. Look, I've got a dot as well I can use now. I'll try not to point it that way. I'll probably have somebody's eye out with it. But I think that was a joke. I can at least point to my slides now. Then after I've done that and I've given you the good news about the planning that we can use because of the manner in which passive income is taxed internationally, I'll be then spoiling all our fun by telling you in the next session why none of it really works. Now that's an exaggeration, it does work, but the point is there are anti-avoidance rules, there are special rules that we need to be aware of when we're undertaking any planning, and before you know what they're about, you're not really equipped to talk to people about the kind of things that they can do with the opportunities I'm going to be talking about. Everyone happy with that? Okay, great. So what we're talking about in this session is, like I say, it's passive income, it's things from unearned sources, if I can put it that way. And so we're going to be talking about dividends, we're going to be talking about interest, we're going to be talking about royalties, and we're going to be talking about fees. And all of these have something in common. But they've got several things in common. They're all passive income, as I keep saying, but they're all subject to withholding taxes. And we'll be talking about the way in which countries' withholding taxes work. The lady who unfortunately can't join us this session, she had some business to attend to. She asked a very open question, do withholding taxes work? Well, like I say, they work very effectively for the country that's withholding the tax. It gives it a first bite at getting some tax that might never otherwise arise to it or indeed to any other jurisdiction. So in that respect, they work very well, but they're fraught with difficulties and fraught with problems. And because of the different rates that can apply for withholding taxes, they present opportunities. And that's what we're going to be talking about here. So we'll be talking about withholding taxes. I will be talking about corporate income tax rates and corporate income taxes as they apply in different jurisdictions. I'm not going to go through lots of different jurisdictions, but I'm going to talk about how the taxation of corporate income in one jurisdiction when interacting with another can present an opportunity. And that's really what this session is about. It's about opportunities. So this morning was all about, oh, it's really, really bad and the world's really bad and we're all being really unfair and lots of taxes are disappearing and this is what the world's doing to stop lots of taxes disappearing. This is a little bit more practical, a little bit more useful and optimistic from the point of view of businesses wanting to get their affairs in the most tax efficient manner. Oh, blimey, that's a long slide. By the way, this is where I blame other people. Bad workman always blames his tools, doesn't he? Read what you will from this. I'm about to blame my tools. I have a particular fashion of slides that I like to use, which are just little pictures or bullet points. Baker Tilly International have always worked slightly differently. As you can see, don't worry about the content on the slides. We'll pick out the relevant bits. You are all going to get emailed the slides later on, by the way. So the content is really there as a source of reference for you later. You don't need to be reading every word. Okay. What is a withholding tax? Well, a withholding tax is sort of tax the wrong way round, isn't it? It's deducted where you have a payment going from one person to another person. And these figure a lot in international tax arrangements. They figure a lot in domestic tax arrangements as well. So, for example, it is used as a mechanism for collecting tax from residents of the same state as that of the paying party. In the UK, when a bank pays you interest, it deducts income tax from that as an individual. It's slightly different with corporates, but there are withholding taxes that apply even within the same jurisdiction. And then they're normally credited in the hands of the person that receives the income. So whether it's something that's deducted overseas, whether it's in the same jurisdiction, you are normally getting some form of credit for that deduction that has been made by the payer. Yeah, everyone happy with that? And they figure a lot. They figure a lot in the international tax regime. What are the issues in the international tax regime? Well, actually, it is quite an effective way of jurisdictions getting some kind of tax take on things that are going on cross-border. The issues are, how do you tie up rates? How do tax treaties fit in with that? There's a lot of confusion here because there'll be withholding tax rates, but the tax treaty might say something else. And as we'll be explaining tomorrow, tax treaties don't tax you. Tax treaties never tax you. They only relieve you from tax. And just remember that for when we're covering everything tomorrow. Another issue with withholding taxes is, how do you know it's been deducted? How do you know it's lawfully been deducted? How can you prove it's been deducted? And so generally, as we'll come on to see, when you're claiming credit for withholding tax has been deducted from a source of income you receive, normally your taxing authorities will require some kind of proof, some kind of certification that that tax has been withheld in the jurisdiction. Not always an easy thing, depending on which jurisdictions you're dealing with. And remember, the payer, it's not in their interest, is it? Okay, they want to keep a good business relationship, but where you're dealing with third parties, the payer may pay over interest, may deduct the tax at source and pay it over to their taxing authorities. They're sorted. How you get credit for it isn't always their worry. That can be an issue. And if anyone here has ever tried to get a certificate of residence or something like that for a company in a particular regime, or tried to get a certificate of the deduction of withholding tax, you'll know what I mean. It can be a genuine burden. Inevitably, a withholding tax produces the possibility of there being double taxation, doesn't it? That's got to be the case. You've got some money that is being paid from country A into an entity in country B. Country A is withholding tax at source and paying that over to the taxing authorities in country A. Country B receives it. Are they going to be taxed on it? Is it going to fall outside tax? Is there some way they might not get relief for the tax in the other country which paid it? So without the right kind of regime, then you can get the situation where somebody gets taxed on the same thing and there's no relief at all for it. And do you remember the example we were talking about before? There was double taxation in that, wasn't there? There were withholding taxes in that, where we were just talking about a dividend payment being made. And there was no double tax. There was no tax relief on that, because actually the double taxation, sadly, in those examples, was taking place at different levels. You got corporate tax down here. You then got a withholding tax on the dividend, which was relieved effectively in the other jurisdiction. Then you got a withholding tax on the payment of the dividend to the individuals who were then taxed on it. Those bits were relieved because they were the same income, but the corporate tax was not relieved against the withholding tax on the dividend that was paid up. So there's always the possibility of there being a mismatch between the withholding tax that you're deducting and the tax that's going into the other country. In simple examples, there isn't one, and you'd expect there to be some relief, but there can be circumstances where you're getting some benefit from that as well. What can a country charge a withholding tax on? There's a clue on the slide. What can't a country charge a withholding tax on? What are they prevented from charging a withholding tax on? Anybody know? Absolutely nothing. A country can deduct a withholding tax from absolutely anything it wants. And in theory, if you provided just salaried labour, or you provided goods, there can be withholding tax from the country that's making the payment just for the purchase of the goods. You could have that. You don't tend to. Withholding taxes always arise on these items, and it's pretty much only these items. And every double tax treaty you read and every double tax agreement and arrangement that you see between any jurisdictions, these are the items which always come up and which are always listed, and you can easily access information on the withholding tax rates that apply to these kind of entities, these kinds of income for different jurisdictions. Do these all sound familiar as things that would you all expect a withholding tax on these kinds of income? A thing to just bear in mind is there's no magic about that. It could be on anything. You could introduce a tax regime feasibly where I sell some goods to you and I have to withhold the tax on payment to you. Then we work it out how you actually get taxed on it. How I get taxed on it after that, and whether there's any tax charge on you. There's all sorts of ways you could do this. Now, when we are undertaking any kind of planning that's going cross-border, where there's a withholding tax charge in force, there's several things that you just want to be aware of and that you want to be thinking about. It's the local rules that you need to look at first. A mistake would be going to the double tax treaty that applies between the two jurisdictions, because what does a double tax treaty not do? And no one's, sorry? Exactly. A double tax treaty doesn't tax you. Thank you very much indeed, madam. That was just to check if anybody was listening at all. You're very good. You're very good. Yeah, way better than the audience I had last week, I'm telling you. Thank you for that. A double tax treaty does not tax you. A double tax treaty is there to relieve you from an unfair burden of tax. Well, an uncommercial burden of tax. That's what a double tax treaty is about. We'll be covering this when we go into this tomorrow. So what you first of all have to look at is what the local tax rules are. What might the double tax treaty do? What might the double tax treaty do? If you look at the local rules and you say that there's a withholding tax of 15% on dividends, what might the double tax treaty do?
Reduce it.
Thank you. It might, well done, sir. It might reduce it, because a double tax treaty doesn't tax you. A double tax treaty only relieves you, and we all know that because I said it, and I wouldn't lie, would I? So a double tax treaty can only relieve you, so you've got to check the local rules first. When you check the local rules, by all means, look at what the double tax treaty says. We've looked at the different sources of income that might be subject to withholding tax, but when you're looking at any international arrangement, that's what you're thinking about. Are these types of income that are subject to the withholding tax? And what about the residence of the different individuals? When we're looking at the residence of the recipient, does that change how it's taxed? May well do, because of the double tax treaty with the jurisdiction in which they're in, because there, as the gentleman said, that may relieve you from some tax. Typically, it will limit the maximum deduction that can be made by the state from which the payment is made. That's normally typically how that works. You want to know what the rate of withholding tax is, and whether the residence of the recipient affects the rate of withholding tax. I think that should say the payer and the recipient. So you're looking at both of those things to determine. All of those things to determine exactly how the withholding tax will apply. But the thing I'd emphasise is that it starts with the local rules, because if there isn't a local rule imposing a withholding tax, there ain't a withholding tax. Doesn't matter what the tax treaty says that they may do. I've touched on this already, but one problem with where you have withholding taxes, and one reason why they can be difficult, apart from the possibility of double taxation, apart from the possibility of there being different layers of taxation and the relief happening at the wrong layer, is that you've got to prove what you've done and what's happened, and you've got to claim it. So there's an administrative burden inevitably. And if you're the company in the recipient jurisdiction and you're receiving something, you're generally going to have to claim some relief. And there's normally a prescribed way for doing that under a combination of the domestic rules and the double tax treaty. And you'll normally have to certify that there has been some deduction in the regime from which the payment was made. Now, you know there was a deduction, your customer paid it over to you. I have had a real life example, by the way, of where a payment was received by my client from, I think it was Turkey, and there was a withholding tax, and it turned out the company that had made the payment and withheld the withholding tax had spent the withholding tax, which is very nice of them. So when we tried to get certification that this payment had actually been made and had the withholding tax had been made, it had been withheld as far as our clients were concerned. It just wasn't tax that had been withheld, it was just a fraudulent theft that had been withheld, which unfortunately when it comes to proving and providing certification of that is a bit difficult, because no tax has been paid to anybody, has it? And that's why that's required. And so an important commercial real point is that in real life, when you're entering into arrangements where you will be required, where you know you're going to be receiving payments from a third party, where you know you're going to be receiving payments that are going to be under a deduction of withholding tax, you want to make sure that you're dealing with somebody who is going to be able to provide you with genuine certification. If they provide you with fake certification, you are party to a fraud, and that's quite dangerous. But the only thing in your favour then is that you're not the perpetrator, and you're also not in the jurisdiction where it was committed, which is helpful as well. But you don't want to be going there. Happy with that? Well, not happy, but everyone follow that? Yeah? Okay, so the point is that there is a real burden where you've got withholding taxes coming into play, and that can produce practical difficulties and can produce some quite uncomfortable situations as well. It might be necessary to prove that the entity which is deducting the tax actually is doing it right and is right in paying it over to the jurisdiction where it's paying it. And that's particularly the case where it's a low tax rate. So for that, you will need sometimes a certificate of residence, and you'll need to go to the local jurisdiction where you believe your company is resident. If you believe it is resident in a country where there isn't going to be a withholding tax on the payment of the dividend or the interest payment, you may need to get a certificate of residence. And generally, that's something that can be achieved relatively easily, but there's timing on this. It takes time to get those. And in real life, that has been a problem on transactions I've been working on, where actually you can't get that certificate quickly enough or as quick as the people want it. Okay, everyone happy so far? Okay, everyone following it, yeah? Okay, very, very simple. We're going to look at several things because there were several types of income I mentioned there, didn't I? Where you can have withholding tax. I mentioned dividends. Oh, look, dividends. That's got to be withholding tax. Then, so dividends, I mentioned interest, I mentioned royalty payments, I mentioned rent actually was on that list. Don't think we've got an example with rent. But we're going to be looking first of all at dividends. And remember, this is about opportunities in this session. So I want to talk about some of the opportunities that exist where you've got withholding tax on dividends. Now, just have a read of the slide. I'll actually just skim through it myself. So distributed income paid by a company that is resident in Saudi Arabia to non-residents suffers a 5% withholding tax. It's better than that where you've got oil and gas. Oil and gas companies. So companies in the oil and gas sector have a 0 rate on distributions they make. So an oil and gas company can pay a dividend to a non-resident participator, and that gets a 0% withholding tax. Everyone happy with that, yeah? This rule applies actually, we're talking about dividends here. What's the difference between a dividend and a distribution? Anybody tell me the difference between a dividend and a distribution? Gives me a chance to drink my coffee while you think of the answer to that one.
Distribution can be made by a branch without headquarters.
It's another. I'm afraid it's another one of my red herring cheating questions. I'm afraid there is actually no difference really. A distribution can be made by a branch to the company, the parent company. Except technically it wouldn't be a distribution. It's actually part of the profit of the parent because there isn't really a subsidiary there. Distribution is the global term for anything that leaves the shareholder value of a company. So where you've got a company, be it quoted, be it unquoted, anything, and basically the assets of that company reduce in favour of the people who are shareholders or participators in that company, that's a distribution. So for example, a repurchase of own shares for cash is a distribution. The write-off of a loan that's made to a shareholder is a distribution. The one we all come across is dividends, okay? Just be aware, just a little tiny nuance, that actually distribution is a wider term. These apply to any distributions, okay? And by the way, that's the reason why as well, as we go through some of this, we use the term participator. A participator is anybody who's got an interest in the capital of the company, usually by way of being a shareholder, but it might be by way of being a loan creditor in some circumstances. So the two terms are kind of interchangeable. Unless the payment is interest in nature and it's got to have different facets, then it's almost certainly going to be a distribution, and these rules apply to that. The regulations do not provide for a credit or any other form of tax relief for income paid on the profit out of which the distribution is made. What does that mean? Where do you get the money to make a distribution? So, madam? Yeah, she's just stolen your answer. You see, you actually, both of you, thank you very much indeed. You both had the correct answer. It's out of taxable profits. You didn't steal the answer. I know that. You came up with it just on your own. You both had the same answer. It's out of taxable profits. You have to have taxable profits. What does that imply? What's happened where you have taxable profits? What's happened to those profits?
They're taxed.
Thank you. These they're never hard questions, by the way, on my presentations. They're more to kind of just, just check you're still with me. They've been taxed. Thank you very much indeed. So the point is there is no relief for those in the distribution system. That's not, you don't get it. So basically the profits have arisen in Saudi. They may have been taxed. They may not have been taxed. Depends on their local regime. Tough. You're getting a distribution now, and that's out of the post-tax profits. And that's pretty much common to every regime I've ever seen in the world. If anyone's got an exception to that, please let me know, because I love learning new stuff. Right, okay, this is how dividends are taxed in the US. This is how dividends paid out of a US entity. So dividends paid from US sources to foreign corporations. It's slightly different here, isn't it? Can everyone see how different it is? They're subject to withholding tax of 30%. Very, very different. I wish I could cover over the next line. What might change that? What? Say? I love that. Can I have a round of applause, please, for that answer? The answer here was, what might change that? Trump was the answer, which is, one, entirely accurate, two, quite funny, and much, much better than the answer I've got up my sleeve, which is actually that one, which is a double tax treaty. A double tax treaty, or Donald Trump, or both, who knows, could change that from 30% to 1 trillion %. It may be happening by an executive order as I speak. A double tax treaty might change that. So a particular double tax treaty between the US and a recipient jurisdiction might mean that there's a low rate applying. And logical enough, it's the gross dividend. So in other words, if you were going to pay somebody 100, you're going to pay somebody 100, they don't get 100, they get 70. They get the 70 after the deduction. So the gross dividend is 100. The net dividend they receive is after the withholding tax, being the 70. The payer doesn't suffer it. The payee suffers it, because they should have had 100. You declared a dividend of 100, gross dividend. Where's my 100? You're not getting it. You're getting 70 because I've taken 30 out and I've paid it over to our mate Donald Trump. Sorry, I'm not making any political statement here. If you're a fan of Donald Trump or a fan of any regime or any leader that I'm not keen on, that's your choice and my choice. Okay, no political point scoring here at all. Okay, let's have a look at a really, really simple example. And this is a simple example, but it's real life. This is what we do use, and this is the kind of thing that we put in place. And this is going to echo already to the previous situation that we had. Now, we've got a situation here where you've got a Saudi company, and can you see that Saudi company owns all the shares in a US company? So the US company is carrying on a trade of some description. It's earning loads of money, and it's going to pay that money back to the Saudi company. Simple. Yeah? Everyone see that? This, ladies and gentlemen, is how that looks for tax purposes. You've got no deduction. Okay, I'm simplifying it. That's your post-tax profit. There's no special deduction for anything else going on here. So your profit is 100. Where's that taxed? In the US. That's taxed at a 40% corporation tax charge, leaving you with profits after tax of a dividend of 60. What's a distribution made from? It's made out of, covered this already? It's made from taxable profits. And we already established that taxable profits, as the name suggests, are profits that have been taxed. There's your taxable profits that are left over. So that's the dividend that you can pay. The US aren't satisfied with that. They're not satisfied with the 40 that they've had there. They want to withhold some tax on the payments of the dividends, so they do. There's withholding tax. That's what's left to pay up to the Saudi company, 42. Blimey, Saudi aren't even that nice to it because they impose corporation tax on that. Is there double tax relief on that, ladies and gentlemen? Is there double tax relief on that? Been taxed there, 40. It's withholding tax there, 18. You've got a payment up by way of dividend into that company, and that's being taxed at 20%. What do you think? Who thinks we get double tax relief on that? Oh, I've got a hand. Thank you very much indeed, madam. I'm so pleased you did that. You're wrong. And that's the reward you get, isn't it?
I hope so.
Yeah, I like the sentiment. I like the sentiment. This is how I reward you. You know, I want someone to be brave and put their hand up, and then I just tell you you're wrong. No, your comment is the lady at the front actually said she hopes so, and I completely agree. Except we can hope all we like. There isn't any, and the reason why there isn't any tax relief here is there hasn't been any double taxation. That company has paid corporation tax on its profits. It has then had a withholding of a withholding tax on a dividend. This company has been taxed on a dividend it receives, not profit, on a dividend it receives. They are different income. Do you remember my 20 quid note? I want relief for the VAT that somebody paid 6 years ago when they handed that over. Not 6 years, actually, it's a new one. I want a deduction for the income tax that somebody suffered when they earned that £20 note. Don't be silly. You can't follow through double taxation like that, and simply put, it's at a different level, so there is no relief. So we got a 66% rate of tax. Everybody see that? Okay, I'll do it again. Is that fair? Don't know. Is it nice? Don't know. Are our clients going to like it? Probably not. They'll like it more if we do what I'm about to describe in a minute. You can, and it's underlined in theory here. There's a reason why I've underlined in theory. You know the reason why I've underlined in theory, because in a bit I'm going to be telling you in the session after the break why we can't really do this in practice, or we've got to be careful when we do this in practice. But you can include intermediary holding companies within a group structure to get advantage of different ways in which different countries withhold tax on different income. And simply structuring something like this produces a spectacularly different result, as we'll see. So you can, by doing that, reduce the withholding tax on a dividend that you're going to be paying. But you've got to take care. You've got to take care, as we'll see. Let's have a look at this. And this is really, really simple. And this is, to some extent, it's an oversimplification, and we'll be talking about the things that we need to be careful about as we go into the later session. But do you remember this? We've got the Saudi company owns 100% the US, and there's a dividend being paid up there, but there's a 30% withholding tax. We all remember that. You must remember that. It was only a slide ago. So instead, we're going to do something else. Is anyone here from Holland? Ah, excellent, excellent. Then if I'm getting any of this wrong, can you correct me straight away, please? But I suspect I'm not, but if I am, please do say so. What if we have... so do you deal with many finance companies in Holland? Is that part of your job, or yeah? Okay. Holland, the Netherlands, is a home of a lot of finance companies that are set up for this purpose. That can actually be a way of justifying the use of one, by the way, because some cracking expertise in this field in Holland. There's some cracking banking facilities that you might be able to make use of in Holland. So some genuine commercial reasons why you might set up a holding company, an intermediate company in Holland. And that's just as well, because as we'll see later on, you're going to need to be able to justify the structure. Because look what this does. If instead of that company owning shares directly in the US, if instead we have the Saudi company owning 100% of the shares in the Dutch company, and the Dutch company owning 100% of the shares in the US company, then it is different. It is very different. When the US company makes its money, yes, it pays the tax on that, as we know, so it's post-tax amount. It pays that up to the Dutch company. There's a withholding tax on that. The Dutch company then pays it up to the Saudi company. There's withholding tax on that. But who's good at maths? What's 5 and 5? Okay, it's 10. I know you're too embarrassed to shout that out because that's just silly. Okay, what was the rate I was talking about before on withholding tax from the US to Saudi?
30.
Thank you. Yeah. Which is higher, 30 or 10? Stop. I'm not going to ask anybody to answer that really. So you can see how you've improved the situation. You've improved it this much. Now, okay, you've still got quite a high effective rate, but it's come down, hasn't it? Because you remember the effective rate on the other one was 66. You've reduced it already by the 13. So the way that works is this. Remember, all you've done is introduced a Dutch holding company. We're not on about payment of interest, not on about payment of royalties, we're not on about doing anything. There's no fees involved here. All this is introducing a conduit company. Oh, I promised I wouldn't use that phrase. dangerous phrase, as we'll see tomorrow or even later on. We introduce a conduit company, which is a company through which we are paying the dividend. It goes from there to there to there. Everyone see that? That's all we've done, but it changed it to this. The profit in the US is still the same, still 100, yeah? Still no deduction. What's changed? Still 40% tax. So our profits after tax, from which we make a distribution, because as you all know, distributions are made out of post-tax profits, out of taxable profits, profits that have suffered tax, so that what's left over afterwards is what you make your distribution from. You're making a distribution from that amount. How is that taxed? Well, do you remember there was a 5% withholding tax when it goes from there to there? There's your 5% withholding tax, 5% of 60 is 3. That leaves 57 in there that can be paid as a dividend up to there. So there's another withholding tax when we make a payment there. Incredibly, because the Dutch are so kind, thank you very much indeed at the back, because the Dutch are so kind, it gets even better. We actually get a refund in Holland of that little bit of tax that we suffered on the way in. Can you believe? Why? It's a commercial decision by the Dutch taxing authorities. Dutch taxing authorities, Dutch government, the Dutch Treasury, or the equivalent thereof, they want to encourage companies set up as finance companies in Holland. So this is what they do. They have a financial incentive. What did I mention earlier on that might give a problem with that financial incentive in the European Union? Forgive me to anybody from Mexico or elsewhere, or the US or anywhere else where they don't know about European. Very good, sir. State aid rules. So the European Union state aid rules might one day say, whoa, what are you doing with this refund? Stop that. Wouldn't make that much difference, would it? Put that up to 55. But they might do that at some point. They're not doing that at the moment, so that's absolutely fine. So just taking on to the example, we get that little refund, which just really sweetens it a little bit more. So the dividend that's received in Saudi is 56. We can't get away from the corporate tax on the receipts of that dividend in Saudi, so we still have a 20% corporate tax rate. But that leaves the shareholder value, what's left over for the shareholders, 47, or a effective tax rate and effective tax rate 53%. Does everyone follow that example? Does that make sense? Just remind me, somebody, what's the only difference between that and the first example? Conduit company. I wish I'd not used that phrase. Conduit company. The reason is lots of new legislation is attacking conduit companies. So where you have a company that really is just a way of routing the money, then there are things that are intended to stop that. We'll be covering that later. Okay. Oh God, there's an awful lot of words on this slide as well. Forgive me. Okay, but we're looking. That was all to do with dividends, yeah. Okay. But there's other opportunities, and guess what the other opportunities are to do with? They're to do with other things that are subject to withholding tax apart from dividends. So there are other ways that you can approach structuring to take advantage of payments that are happening cross-border that aren't dividends. And really, it's where you can find something that is a deductible payment in the country that's suffering the big tax charge. Remember in this one? Loads of tax there, loads of tax there. What if we can have a payment that actually puts a number in that line there so we have a deduction? Can we have a payment that does that? And clearly we can. And this is what we're talking about next. We're talking about interest, and then we're talking about payments for royalties or payments for fees. And all of those can put a deduction in that line there. And you can see, actually, that really eats into the real tax problem, because that's the biggest tax number on this slide, isn't it? So if you can eat into that, then you might be doing something quite special. And what that does is it means where you're able to do that, it takes away the tax charge from the corporate income tax that we suffer right at the top of that slide, and the dividend withholding tax, and instead shifts it to whatever withholding tax might happen to apply to the sort of payment that we're talking about. So withholding tax that might apply on interest, for example, and how that amount is taxed in the receiving entity. So you might get a situation where, I mean, ideally what you're looking for is you want the withholding tax rate on whatever payment you're making to be low. You want the receipt in the country that's in the company that's receiving it to be taxed at a low rate, if at all possible, and if at all possible, you want it to be tax deductible in the country that's earned the money. Everyone see that? Okay, that's all you need. Which can be quite hard, but we've got some examples where we can see how that does work in practice. Of course, I've got some examples where you can see how that works in practice. Would have been a bit silly if I'd made the point without having an example that I could then show you. So let's have a look at interest. Interest. Well, what is interest? You might think that's obvious. Everyone knows what interest is. You have money at the bank and you get paid interest, or nowadays you don't. But everyone knows what interest is. Except, of course, it does have to have a specific definition, and you've got to be quite careful about defining what is a debt which pays interest and what is something that really is capital in a company in the form of a shareholder fund, so in the form of shares in the company, for example. And there are complex rules about what distinguish a debt from equity, and so that isn't always obvious. But where you've got something that is income from loans, which is the terminology that's actually used in the Saudi legislation and the double tax treaty, you've got a 5% rate. As I say, there's some definition, but there's no sort of big definition of what income from loans means. But most people, it's like an elephant. You'll know it when you see it, yeah. And you'll know when something is interest. It's only some things that might not be where you'd possibly have the problem. That 5% rate might not even be 5%, because what could reduce it? Thank you very much indeed, madam. A tax treaty, yeah, a double tax treaty. Because what does a double tax treaty not do? It doesn't tax you. What does a double tax treaty do? Exactly. You see, whatever happens on this course, you'll all remember that. Okay, here's where this works. Here's how this works. A simple example where we've got an interest deduction. So this time what we've got, and flick back. Do you remember with this one? All taxable there, but we're taking advantage of double tax treaties to get different withholding tax rates on the dividend payable. Here's very, very different. In this instance, we've got we've got the Saudi company, which owns 100% the USA company, still exactly the same, except this time we've lent a whole load of money from the Saudi company into the US company. So we've got interest payment coming back into the Saudi company instead of dividend payment. What does that do? The big difference is here, because we now have a deduction on that line. That's a deduction for the interest that is payable from the US company into the Saudi company. Yeah, everyone see that? What effects does that have? If it's deductible, then we've just reduced that from 40 to a big fat 0. Then all we've got to worry about is the withholding tax from the US that the US will deduct in paying when we pay the interest from there to there. And that withholding tax, yeah, it's a big number, it's 30%. I say it's all we've got to worry about. We've also got to worry about how that interest is taxable in Saudi, and it is taxable in Saudi. So that interest there that we've got, you've had a withholding tax on it, but it is taxable in Saudi because you've got a corporate interest rate of 20% in Saudi, giving you a 14 deduction. But we've got the effective tax rate down to 44. So it's an improvement again on what we had before. Everyone see that? Okay. Does everyone see how that works? Everyone see what we've done? It's really simple. As we said on the earlier slide, we've shifted the burden of tax. We've shifted the burden of tax from their taxable profit locally, from being there, because that's the rate, and that's the biggest rate you've seen on any of these slides. We've shifted it from there into being the withholding tax there and the corporate tax there, and their lower rates. That's all we've done. Everyone see that? Okay. What did I mention earlier on that might be scary to do with that as an idea? If I put forward that as an idea for any one of your clients, what might any of you go, well, hang on a second, didn't you mention? I don't remember. It's one of the BEPS actions. Sorry, that's entirely true. The substance behind the transaction is entirely true. So what might be the issue with substance here?
That's a real loan or
Yeah.
for something that the Saudi Arabia is actually doing there.
It will have to be a genuine loan, won't it? And you'll have to really be able to demonstrate probably that you've got a good commercial reason for making it. And there is already legislation that can tackle that. You've got legislation on thin capitalisation. So if instead of subscribing for shares in that company, you're just lending to that company, then in some local jurisdictions, US and UK definitely, you will have some restriction on the deduction. There's the reality of it, just general anti-avoidance principles. And does it have real substance? That's entirely right. There's another one as well which I mentioned, which was the cap on deductibility for interest. And remember, that would actually exceed the cap on deductibility for interest, wouldn't it, in the UK? But is the one in Saudi? Don't think so. So you might be fine. Is the one in the US? Well, there is one in the US, but I can't remember what it is. But you'd have to be aware of that. And sir, did somebody have their hand up as well, I think? Did somebody else raise their hand with a suggestion on that? No? Okay, no worries. But yeah, but you're dead right to raise that. So this isn't a gimme. It's not guaranteed. You can't say this is just what we do and it's fine. You have to think beyond that. We can go further. We can sound like the treasurer, but I want to do more. We can go further than that. We can actually combine those two ideas together. But again, this is still using interest, remember, not dividend. Do you remember last time we had the Dutch company there? We were paying dividends from there to there to there, and we were pretty much passing the dividends straight on. We were getting the advantage that the withholding tax rates were low. Everyone remember that, yeah? Okay, well this is actually, it's not the same. This is actually different because we're using a Dutch company to make the loan down here to the US. We've funded the Dutch company, probably with loan itself actually. Looks like it is from that. So we've funded the Dutch company and that has then made the loan down to the US. But this is what the numbers look like here. Remember again, we've done the big thing. We've taken that number down to 0. And we've done that by getting a deduction for the interest, subject to the commerciality of it, subject to thin capitalisation rules, subject to transfer pricing rules, subject to any cap on the maximum deduction that you can get. So this may soon have to be a different slide with a less of an exaggeration. But let's say we can do that and we can get the local profit down to 0. We've managed to do that. We've then got interest that's been paid up into the Netherlands, but the withholding tax on that is actually 0. And why is it 0, do you think, between those two countries? I can tell you now that's not what the US domestic law says. Why is it 0? Thank you. Because of a double tax treaty between the Netherlands and the US, yeah? Okay. So we don't have any withholding tax there. We don't have any withholding tax there. So we're left only with that. And you can tell this is good news because the Saudi rate of tax now matches the number there as well. So in other words, that's the only one taxing any of that 100. So we've now got it down to a rate of 20%. Everyone see that? Really simple. And yes, this is a simplified example, but that's an opportunity that is available because of the way that withholding tax rates work on different types of income in different jurisdictions. Yeah? Excellent. So we covered dividends. And in the example with dividends, we used a Dutch company. We interposed a Dutch company just to mean that we got a different rate of withholding tax and a lower rate of withholding tax on the dividend going into Holland and out of Holland compared with the dividend going straight up. We've looked at interest. Remember, interest does something very different from dividends, doesn't it? It's not just withholding taxes. That's actually shifting the tax out of the US because it's getting a deduction in the US. Yeah? Now we're going to look at royalties. And we're looking at royalties. Sorry, spoiler alert. The end result's going to be very much the same, isn't it? Probably. Why would we, if we can do that with dividends, why am I even giving you, sorry, with interest, why am I even giving you the example of royalties? Why am I bothering? We'll just do it with a loan. What's the problem? Madam, what was your point about what we needed to do with the interest? What did it need to be? Dead right. It's got to be real. If we've just magicked a loan out of thin air and the maximum amount of cash we can raise is 10 million quid and we have to charge 50% interest, it's just made up. It's going to be caught by lots of special anti-avoidance rules, so we don't want to do that. So it may well be that there's a much better commercial justification for getting a royalty payment. It may be that we can actually put an asset, an intangible asset, into not a Dutch treasury company, but into a non-UK entity, which justifies a royalty payment. That's really why I'm talking through this example. Okay, this may be more justifiable in terms of the commercial reality that exists in the arrangement that we're looking at. What's a royalty? And by the way, it looks like your withholding tax, I'm afraid, is not so good because we've got a 15% withholding tax on a royalty. What is a royalty? Anybody suggests it's written on the slide if anybody wants to help with answering this question? Everyone happy with what a royalty is? Anyone unsure about what a royalty is? I mean, the dividing line really is, it's not a payment for anything. So if I rent a flat, I'm not paying a royalty, am I? I'm paying rent. Why is that different from a royalty? I've got an asset, I'm using it, I'm paying something to use it. What's the big difference? The term royalties is normally restricted to intellectual property, well, intangibles at least. So not something you can touch like that. That was risky. If that had landed on the ground and broken, then my clicker would have been history. It's not something tangible, it's something intangible. So it applies to intangible assets and natural resources. That's what royalties usually apply to. So when you're paying somebody for the use of, I don't know, for the use of airspace, that can be a royalty payment in respect to that, believe it or not. If you're paying somebody for the use of their knowledge, their intellectual power, then that can be a royalty. If you're paying somebody the use for their brand name, think Starbucks, best example, that will be a royalty payment. So it's normally for something intangible. Everyone happy with that, yeah? Because that's really where the dividing line is. But it's a very wide definition in the Saudi law and pretty much in all law. But here's an example with royalties, and you can see actually, madam, to answer your thing on your point on the front row, this ain't as good. So actually, it's not even coming back to the same result; it's coming back to a worse result because actually, far from getting a better withholding tax rate, we've got a worse withholding tax rate. But the reason we might still do it, it might just be that we can justify this, whereas we couldn't justify the dividend. So it looks like this. We've got a situation where we've still got a US company that's undertaking the main business, yeah? We've got a Saudi company and that owns the US company, so it's all the same. So we could pay a dividend, we could lend money and we could pay interest on it, but we might be restricted on that. It might be that just doesn't look very commercial. So instead, what we're going to do is we're going to say to the US company, look, US company, our brand name, you can run out there in the market and you can use it like it's your own, provided you pay us a big fat royalty for doing that. The point about the royalty is, once again, it's there. That's the big news. It's deductible in calculating the US profits. It's deductible there. Local tax in the US is therefore nil. There's a dividend then that can be paid from the US. So the dividend is nil, so we're not paying a dividend. There's payment of royalties that go from the US into the Saudi company. And the withholding tax on that, I'm afraid, is 30%. So I'm afraid we're not got as spectacular results we had before. We've still got the corporate tax in Saudi at 14%, but we're still better than the very first number we looked at, aren't we? We're better than the 66% than what we started with, which is what we started with. So we've improved the position dramatically, and the point is that might be a much more commercially justifiable approach than anything involving interest or possibly even anything involving dividends being routed through a Dutch company. Everyone see that? And to be honest, most of the BEPS agenda, most of the kind of anger at the use of international structures that appear to unfairly, in some people's view, avoid taxes in the UK or elsewhere, most of that is driven by use of intellectual property arrangements, where you've got payments going into zero tax regimes for the use of some very big names like Google, like Amazon, like Starbucks, and lots more we could name. Where all of them have arrangements whereby a company in a very low tax jurisdiction or zero tax jurisdiction is benefiting from their name by the payment of royalties. Yeah? So it's the big thing that's driven an awful lot of BEPS. You could go one better than that structure, and you could go one better provided you have some commercial reality for it, provided it's actually real, provided you can justify it. And the way you could go is, again, using our friends from Holland. You're the stars of the show. You're figuring on lots of things we're looking at here. So what we do in this situation is we introduce a Dutch company in the middle, again, an intermediate company. We won't call it a conduit company anymore, an intermediary company or intermediate company, whichever you prefer. The Saudi company owns 100% of the Dutch company. The Dutch company owns 100% of the US company. So what we've got again is we're reducing the profit in the US. The profit down here, again, we've got 100% deduction for the payment of the royalties. That's the really big hit. That's why we're saving all the tax. So we're taking that 40 out. We're then making a royalty payment from the US into Holland. Oh, look, there's a 0% withholding tax. you remember before when it was going straight from there to there? It's 30% withholding tax. Now it's a 0% withholding tax. I'm not even going to patronise you by asking what it is that reduces that to 0% from 30%. You know it's the double tax agreement between the two countries, because I don't know if you know this, but the double tax agreement doesn't tax you, it actually reduces tax, and this is where it has reduced tax. So it's reduced that to 0 from that payment to there. And then what you have is you have the royalty that's received. Where's it gone? So that's the royalty to Netherlands, no withholding tax, there's no tax on the receipt of it at all in Holland. You then get that paid up from Holland into Saudi. Again, we've got a withholding tax of 0. So the only rate that we have is in Saudi at 20%, and we're back to that super fantastic low rate of 20%. So again, we've got the spectacular result that we had with the dividends, remember, but possibly with something with a lot more economic reality. So something that's, you'd imagine, more capable of withstanding scrutiny and standing up to the kind of new rules that are being introduced because of the BEPS changes. We have covered dividends, we have covered interest, we have covered intellectual, I just blanked there for a second. We have covered royalties, thank you, and on the intellectual property. We're going to move on now to looking at another example, but involving fees. And it's really similar. I mean, you've got the idea now. So why are we even looking at this example with fees instead of looking at royalties or dividends? We've already seen what we can do with royalties. Why are we looking at fees? Because it might be more commercially justifiable. It might fit with what is actually going on. And the more something fits with what is really going on, the better chance it's got of standing up to any scrutiny or any attack by anybody who doesn't particularly like it. Okay? This is an example using fees. Now, there is a withholding tax when you get a payment of fees that's made from Saudi Arabia to a non-UK resident, and it looks like this. It's 20% for management fees and 50% for technical and consulting services. And I think I mentioned in the first session there's a real problem with fees and how commercial arrangements are often structured. And I've got to say it's a good example of where the people that write the tax legislation probably don't necessarily get some of the things that really happen in real life. And the best example I could think of was that thing with my architect clients, where they were having, for commercial reasons, to charge a fee, most of which would actually be paid away to third parties. So they were charging 100, but that 100 was to cover the build. They were actually going to have to pay for somebody to build the thing. And why were they doing that? They were doing that because they wanted to hold on to the intellectual property. They wanted to hold on to the drawings so that they could use them, and other architects couldn't spot what their clever little ideas were along the way. They didn't want them being shared. The only way to do that, and somebody to pay them the 20, which is a huge fee, call it millions, 20 millions, was to charge 100 million, but take away the build cost for the client. Okay. The real problem with that is the withholding tax. Technically, that was on fees, so we had to restructure the contracts. I mean, it wasn't, but I won't bore you with the rest of that. But they're the withholding taxes that we have in Saudi Arabia on fees. So this is going to look really familiar, because again, what it does is it reduces that by the 100, so it takes the pain away from the profit in the US to mean that the local tax in the US is 0, so we don't have 40%. We have a payment of fees then from the US to Saudi. The withholding tax on that is 0 because of the double tax treaty, so therefore we only have the taxability in Saudi. Everyone see that? Been over the same example 3 times now, except it's not the same example. The point is it uses something that commercially is different in each case, and that's the whole point, that the commercial drivers may dictate that actually using fees is completely justifiable, whereas using a payment for interest just wouldn't work. Everyone see that? Yeah. Right. So to summarise what we're talking about there, what you've got to think about when you're putting in place when you're advising anybody, speaking to anybody, even touching on the possibility of some kind of arrangement which has any kind of cross-border taxability such as that, you've got to be thinking about what the corporate income tax rates are, the corporate tax rates, in other words, in both jurisdictions. In the jurisdiction where you're really doing the work, Because remember on those examples, that was a real cost, wasn't it? It was in the US, you got a 40% tax charge. You've got to think about that first off. What is that tax charge there? What's going to be the corporate tax rate in the top entity, the entity that we might be advising that is eventually going to receive the dividend or the interest payment or the royalty payment or whatever it is? You've clearly got to think about withholding taxes. Two places you need to look for the withholding taxes. They are the domestic rules, I won't patronise you, and the double tax treaty. They're the two things you'll need to look at to check on the withholding taxes. What other documents should you look in as well? EU directives is entirely right. There may be a restriction on EU directives. The EU directives won't enforce anything necessarily, but it would mean there could be a challenge from the European courts. Unless there has been a challenge from the European courts, you can go on your merry way, but you'd worry about it. Or the other way, you'd be very happy about it, because lots of UK anti-avoidance legislation we thought was illegal under European law, and lots of people, not myself actually, but lots of people advised on arrangements that assumed they'd never be able to enforce it, and they were right, they didn't. So EU directives is right, but that won't actually change the rate applicable. It might make you wonder whether the rate is ever enforceable. So there's one other thing I mentioned. It's the multilateral instrument. The multilateral instrument will be something that, as advisors, anyone advising on international tax, you have to have it there alongside you when you're going through anything. I think in most cases it'll be a bit like the EU directives. I don't think it will actually change anything. But the point is, if the multilateral instrument says, look, you really should be having a rate of withholding tax on a payment to any jurisdiction that has that corporate tax rate below that, you really should have a rate of withholding tax that's at least this, then you'll have to wonder whether that will eventually come to pass. So it's a bit like the EU directives. So you've got to have all those things in your mind. The big ones, though, are the local rates and the double tax treaty, because that's now, and that's irrefutable. Okay. You've got to think about if you're paying dividends, so if the dividends are received in the top company, how are they going to be taxed in the top company? What withholding taxes apply to them? And I've already said that. That's what we've got to worry about. We've got to worry about the fact that does something in the multilateral instrument mean that even if they're getting away with charging 0 now, at some point they're going to be told to make that 15, or they're going to be told to make that 20, and that's both the BEPS, the OECD BEPS, and the point that was made by the lady is the EU directives as well. So other international law may come in and stamp on the benefit we get from it. Everyone okay with that? Yeah. Now, we've touched on a couple of these, and this is, it's important because those examples were spectacular, weren't they? We're getting from a 66% rate to a 20% rate, just really by putting in place a couple of holding companies, or a holding company, and changing the manner in which we make the payments. So stopping it just being a straight dividend up, just to doing those. Oh, God, this job's so easy. Do I really get paid for doing this? Except it's not that easy, is it? Because there are several things that we need to be careful about. And this is through a combination of domestic laws in the countries with which you may be dealing, and some international laws. It is possible that you could, for example, find your arrangement challenged by one of the jurisdictions, not under their own law, but under, for example, European law. You could go to the European court. This has happened. It's normally the other way around, actually. It's normally the taxpayer going to the, every case I can think of has been the taxpayer going to the European courts and saying, you shouldn't be stopping me having this tax benefit. And the freedom of movement under the Treaty for the Functioning of the European Union, forgive me anybody out from outside the EU, oh blimey, outside the EU, that's me now as well, isn't it? But very nearly anyway, forgive me anybody outside the EU, but the Treaty for the Functioning of the European Union is the international agreement. It's the cornerstone really of most of what goes on in the EU, and there's fundamental freedoms within that. One of those fundamental freedoms is movement of capital. Another fundamental freedom is freedom of movement of workforce and services. So if you have a tax rule that is preventing any of those freedoms being used by any member state or any entity within any member state, then the taxing authority can be challenged, and has been successfully challenged under those rules. So, for example, domestic example again, the transfer of assets abroad overseas rules, which are really complex in the UK, they were challenged successfully by somebody, and the UK got told to rewrite the rules. which they did. And then that led to Brexit. They rewrote those, they didn't rewrite them much, but they rewrote them a little bit. So it can happen the other way, but you've got to worry, do have to worry about whether any of these arrangements can be challenged by domestic tax authorities under their law or under some form of international law. And for that reason, you have to worry about whether there is any real substance in any of this. If I use the term a letterbox company, would you all know what I'm on about? So that it was, yeah, it was. What we mean by letterbox companies, you know, any of us today can set up a company. I could literally set up a company while I'm standing around at the front here. I'll be looking at my mobile phone and doing all this, but I can easily set up a company that way, and you transfer 100 quid and there the company's set up, it's registered at Companies House, it exists, that can be done. You can even electronically sign the documentation for that. So it's literally something, but I say I could do that. I'd need to know an awful lot more than I really do. But I really could, in theory, it would be possible for me to create a company here and now while I'm speaking to you. Now, so that's created, that's a legal entity that exists. Okay, where's its office? Where's its reception? Who do I ring? Where's its website? Oh, haven't got any of them. Doesn't need any of them. It's a legal entity. It exists. That's all it is. It's a legal concept and it has legal registration and it does have legal identity for tax purposes. But is it real? And increasingly, arrangements will be challenged where that's all you have. In fact, arrangements will be challenged where you've got way more than that, but you haven't got enough to give it real economic, commercial and legal substance in a particular jurisdiction. So that's going to get tougher. This is a concept that is appearing more and more in different countries' legislation and in international law, and this is going to become quite important. Recently, so who here is from the UK? Can you just raise your hand if you're from the UK? Yeah? Okay, so we've got a few hands, great. You'll know, guys, recently we had changes under local company law rules and under accounting rules to mean that we have to notify to the Companies House, being our registrar of companies, we have to notify who the beneficial owner of a company is. Now, the beneficial owner might not be the person who legally owns the shares. In the UK, we have a concept of trusts, for example. I can legally own this, but I can hold it for your benefit. So if I sell it, so I sell it over there, can you give me some money? Okay, give me an IOU, it's your money, it's not my money. I'm only the legal owner, and that's called a trust. That's a trust arrangement. I'm the trustee, you're the beneficiary. There's a difference between legal and beneficial ownership. We now have to point out that the lady on the front row here is the beneficial owner of this, even though I'm the legal owner of it, if these are shares in a company. Increasingly, the tax system will follow that. So the tax charge will go to the beneficial owner. So who is the beneficial owner of an entity will become more important. So in my examples, was the beneficial owner Holland? Was that the beneficial owner of the US company? Not so sure. I think it was the Saudi company that was the beneficial owner of that. And at some point, with the BEPS initiative, the tax rules will follow that. There are specific anti-avoidance rules on all of this. We touched on, earlier on, we touched on the restriction on the deductibility of interest. That's about to come in. Like I say, the UK election got in the way of that, but that's about to be introduced. It will make it onto UK statute. So that's a specific anti-avoidance rule. That means we can only get so much interest deduction. There are transfer pricing rules, thin capitalisation rules, all those things that are specific anti-avoidance rules. There are also now general anti-avoidance rules. Does everyone know what I mean by a general anti-avoidance rule? A GAR. Does that mean something to everybody? For those of you who've not come across the concept, I'll just tell you, we do have a GAR now under UK law. And very simply put, a GAR is a kind of catch-all. I mean, it's a horrible thing, really, when you're working and giving people tax advice. But if all else fails for the UK tax authorities, if they can't find any way to defeat an arrangement that we have put in place, they can say, aha, we accept that you've not breached the transfer pricing regulations. We accept that you've not breached the thin capitalisation rules. We accept that the deduction for interest is within the boundaries that we talked about, but we just don't like it. And we don't like it now, it's not as broad as that. They can, if there's anything they didn't like, then we'd all be bankrupt, to be honest. But they've got, if they're within the wording of the GAR, then they can still challenge it. And by the way, GAR in the UK stands for General Anti-Abuse Rule, and there's a hint in that because it's intended to be restricted to things that are abusive and that are really going way too far, way further than anyone could have imagined, except nobody knows that. And can anybody tell me a question for you, just to check everyone's listening still? Actually, this is a hard question. For anybody not from the UK, it's an incredibly hard question. How many times has the GAR been used? It was introduced in 2013, 4 years ago. How many times has the GAR been used so far?
I think there's one going through.
Ah, there would be, wouldn't there? I think you're right, actually. Somebody else told me that. Do you know what it's on?
No.
No, okay, yeah. So far, it's not been used, although we believe there is a case about to make rear its ugly head. Not, yeah. That would have been really embarrassing if someone said, "I've got 6." Yeah, The GAR hasn't been used yet. Why has it not been used? That makes no sense. What's the point? In pressing Parliament to introduce a general anti-abuse rule, which HMRC did, they threw all the weight behind this. We know this. Why do that if they're not going to use it? It's not intended to be used. It's a deterrent. It's intended to scare you away from things. It's intended to make sure people like me stand up in front of you and warn you about it. Because otherwise, if it didn't exist, I would have said, off you go. Guys at the back, 3 people from Holland, set up as many Dutch companies as you possibly can and just route everything through them, no worries. Okay, the GAR, it's not only the GAR, but the GAR stops anybody doing that, doesn't it? It means we have to stop and think, and that's what it is. It's a deterrent, and it's only intended to be a deterrent. The reason they've not been using it is if they lose, the deterrent's gone. So they don't want to lose at all. They'll only apply it where they know they're going to win. So I've got to say, if you've got a GAR case, if they're taking you with the GAR, then you can be pretty confident you're not going to get anywhere with it because they must have found something that they are absolutely certain they will win on. I've been advising on several things where we're worried about the GAR and they've not applied it. But, you know. Okay, thanks, guys.